Attention! This video is intended for the purpose of educating and understanding the Forex market. It is not created to induce investment. Investment is risky. Therefore, investors should study information before making an investment decision.
Hello everyone, welcome back to the basics learning about Forex trading, and we are now in chapter 6. In this part, we're going to learn about these two topics. The first one, we will start by talking about discipline, the key to success, and then we move on to the part of different trading strategies, okay? So we're not gonna waste our time. Let's get started. The first topic that we're going to learn today is about discipline in Forex trading, or the key to success in trading. So many times we often hear that Forex trading is a good one. There's 60% of the my capital management, or 30% of money management, and 10% of profitability techniques. Investors can see that the most important thing is psychology, or beating their own hearts. No fooling yourself, not taking sides, overcoming greed, accepting risks, and making decisions to give up losses when analyzing the wrong graphs is all about psychology. This is a record of trading discipline that we must follow in a straightforward way. If investors lack of discipline, they will not succeed in investing. And the disciplines in Forex trading can be divided into 7 ways. The first one, discipline enough. Discipline is an indicator of when we should trade or stop. Secondly, not tolerate losses, waiting for profits to return. Thirdly, trust in your own profitable approach. If investors have techniques that can make a good profit for themselves, they can do so. Use the same technique, profitable, continuously. Even if you can sometimes make loss, trust in your techniques. Every trading technique is not 100% profitable for every order. Use techniques that you are good at and develop knowledge. Fourthly, view trading as a long-term profit. Don't put pressure on yourself by hoping to get rich in a short time. The more impatient and self-pressured investors are, the better investors themselves will become more stressed. This causes you to trade emotionally, ignoring your own strategy. Trading patterns will eventually have a negative impact. Fifthly, wisely accept losses. Always thought we couldn't always win in the market. Investors should accept losses at acceptable points. Allow losses to prevent excessive losses. Number 6. Be patient to make profit. If the order is analyzed by investor and it is the right way to go, so be patient and wait for the profit to be made according to your targets. And lastly, don't take past losses to devalue themselves. No one likes mistakes, but we can avoid it. Don't bring mistakes to discourage us, but take it as a lesson in how we can improve ourselves from the same mistakes. Well, let's learn about the trade with support and resistance trends. The key to Forex trading is support resistance trading. Understand this model as a basic. It can be profitable. Resistance and support points are an important area to tell traders where to buy and sell. Now let's take a look in the details about support point. The support point is like the pickup point doesn't let the price stop, whereas resistance is like a point against the price from passing upwards. The support point and resistance can be destroyed in case of there are many demands and supplies of a severe in buy or sell, so that it can't be controlled. Support can become resistant, and resistance can also become supports. The support point is like a purchase point. When the price is falling towards the support area, investors find an opportunity to buy back. There is less seller in the market due to the price is quite cheap. Then, as a result, when the price touches the support zones, there is usually a buyback force. As this result, price have recovered. but there's no need to reverse it every time. If a sale force is greater than the purchase one, the price will fall off the support line. This makes the next support cost lower. Now let's take a look in the details about the resistance point. It is like the point for sale. When prices rise to the resistance, it is a time when investors see it as expensive. As a result, many people sell profitably in that area. The buyer has a smaller number because the price has risen, hitting the resistance level, resulting in a strong sell-off. It's weakened prices, but not always either. If the purchasing force is too large, even the price will be higher, the resistance will be destroyed. This creates a new resistance that comes at a higher price. If you want to be profitable and enter a safe area, you must buy at the support and sell it at the resistance area. But if you accidentally buy it at the resistance, it probably stuck. If a graph is reversed or if it is sold in the support area, it may be a sell at a price that is too cheap. When the graphs bounce back and when it finds supports, it becomes negative immediately. Now let's move on to the second topic here, and we're going to learn about the different trading strategies. We start by talking about the first theory, which is called Dow theories. Dow theories is one of the concept of analyzing graph, new high and new low. In order to analyze the trends of the price chart, you need to check if the top of the lowest point has occurred. Analysts will wait for the clear reversal in the price range before counting down the new high point. The benefits of the trade with Dow theory is that traders can wait for the right moment to come in and make a purchase or sell. The Dow theory can be classified into trends. The first one is about Dow theory tracking uptrend. The new lows are higher than the old ones, and the new highs are higher than the old ones, which are only out of trend, when the new highs are lower than the old ones. Now let's take a look on the second trend, which is about Dow theory tracking downtrend. The new lows are lower than the old ones. The new highs are lower than the old ones, which runs out of trending when the new lows are higher than the old lows. Now let's move on to the next strategy, which is about the RSI theory. RSI is one of the technique analysis tools that can be used for trading effectively. It is in momentum indicator categories that measure price range. When using the RSI theories, it helps investors to indicate a condition in which overbought and oversold is made, which can be seen when the RSI lies land overbought or higher than 70. In case of the large number of purchasing forces, the price may be lower, and when the RSI runs down lower than the oversold line down to 30, when there is a strong sell-off, the price may increase, and using the RSI benefit the investor in this way. Firstly, price reversal around, or even reversing a line from non-target swing or faulty swings, and this also acts as a trend identification or resistance line, and as well as signal the inward directions of the ongoing price that will continue. Now let's take a look into the next theories about MACD. MACD is an indicator in the oscillator categories that measure the swing of the price chart or apply to markets that are moving sideways. However, most traders prefer MACD in trend condition. Talking about using MACD theory, it benefits investors in two ways. Firstly, this makes it possible to know the trend of price chart going up or down. If MACD histogram is on line 0.00, this means that the price chart is an upward trend. If it is below the 0.00 line, it is a downward trend. Secondly, it tells us the trading signals. When MACD histogram cuts the 0.00 line, if it is turned down, then you should sell. And if it is turned up, then you should buy. Let's learn about the next theory, which is called stochastic theories or STO. It is another momentum indicator which shows the momentums of the price, how many percent of the change will be in a given period of time. Stochastic sensitivity is the display of market sensitivity at any given moment. Stochastic graph analysis is divided into two zones. The first one, overbought zones, it's a value of 80 or higher will be available. It means there is a lot of buying in. There may be a change in trends showing as green bars depending prices may fall. Secondly, oversold zone. It will be from 20 down and means that there is a strong sell-off and may change the trend showing as a red stripes. Down prices may rise. Next theory is about Bollinger Band. It is an indicator for analyzing forex market price movement. When using Bollinger Band, it benefits investors in many ways. For example, it is used to measure market volatility by viewing from the line. If the lines are close together, the market is quiet or in a sluggish period, but if the line falls apart, the market is bustling. Secondly, it is used as support and resistance. Bollinger Bands consist of three lines. The upper line or upper band acts as a resistance. The middle band acts as both a support and a resistance, and the bottom line or lower band acts as a support. Thirdly, it is used to find price trends in two ways. The upward trends, the price characteristics, are located the upper border and rarely break through the middle border. And downward trend, the price characteristics, are located on the lower border and rarely break through the middle border upwards. Lastly, it is used to trade with breakout strategy is to enter the trade immediately when the price breaks through resistance and support. Now let's move on to the next theory, which is about moving average or MA theory. It is the line of average price that appears in the graph. It is used to analyze market trends or directions, and there are two common types of use. Firstly, as simple moving average or SMA, and secondly is about exponential moving average or EMA. But let's discuss about the SMA as it is an average line for finding support and resistance. Because the SMA line is an average line that equally prioritizes the day, there is no swing in the current price. Whereas the EMA is developed to reduce weakness in the SMA line by increasing the weightings of data and make it susceptible to price change. When price change occur, the EMA line will be changed significantly with the price, reflect price rather than average lines moving in other ways. Now let's move on to the last theory, which is called candlestick. A candlestick chart is a chart of information that is commonly used in the forex markets for reading the directions of the price, which can provide you with complete information including highest price is the highest point that the price reaches, close price is the closing point, body is the distance between opening and closing prices, open price is the point at which the price is opened, a low price is the lowest point at which the price is reached. Take a look in a deep details about the part of the body in candlestick. Green candlestick will be uptrend. It is called bullish or bull market. It looks like the opening price is lower than the price, and the red candlestick will be downtrend. It's called bearish or bear market. It looks like the opening price is higher than the closing price. If the candlestick has a very long candlestick structure, this means that candlestick have a strong buying force. If the candlestick has a short candle texture, this means that candlestick have a small buying force. And lastly, if the candlestick had a long candlestick and no candlestick at all, indicates that the candlestick is very bullish or bearish.
Contact us for more at newwinfx.com or to scan our QR code right in front of you.